Good day, fellow investors. There is so much blah blah and noise in the investment environment, and on this channel I want to clear out that noise and discuss what really matters when it comes to investing. Let me know in the comments below whether in this video I managed to clear the noise, and if not, what to improve. Let's start. Just a quick example about the noise. If we take the last 12 months, the market is up 12%. So much about crashes, about this or that. The market is still significantly up. Not even to mention 5 years. Look at this, 88% up. But of course, there are so many topics that plague the news, the environment, especially YouTube crashes, interest rates going up. But what is it that really matters? Let's dig into it and then see how it impacts the core fundamental of investing, and that is owning businesses. Let's immediately start with inflation. After years of low inflation, we finally have significant, even I would say high inflation, and we are reaching almost 8% in February 2022. And now we also have the Fed saying how they will have to increase interest rates, 6 hikes forecasted for this year, thus again an environment that changes significantly compared to what we have been used in the past. And of course, this is even a better chart for inflation. We are now at levels last seen in the 70s and the 80s. So really, inflation has been low for decades, and now this is really a change in the environment, and that's something one has to keep in mind, but then again up to a certain level. And as we said, the Fed is signaling 6 more increases this year because inflation is too high, the labor market is overheated, and price stability is a precondition for the central bank as it tackles the hottest price pressures in 40 years. And then higher interest rates lead to less economic activity, as that's what Powell is doing by curbing inflation. And he says that the American economy is very strong and well positioned to handle tighter monetary policy. But what does it mean, tighter monetary policy? The projections are, yes, for rate hikes, but 6, and then we are at 2%, maybe going closer to 3%, and that's about it. But inflation is close to 8%, so that's already something that is important here. Plus, on what Powell says, Powell had been talking about inflation, how it is just transitory, or earlier how it will likely be, how it hopefully will be 2%, and I always told people that nothing will happen in a linear way. So from 2% and very low inflation, we boomed to high inflationary environments, and likely not more transitory as Powell says. But if we listen to what he had been saying and to what he is saying, there is always what he has to say. So, of course, he has to say that the economy is very strong because he influences also the economy with what he is saying. But this is exactly what's important here. Powell and what he says is irrelevant because not even Powell knows how will the environment be 6 months from now, and not even talking about 2 years from now. The fact is that despite wage increases, still over the year, the 2.4% wage cut because inflation was higher than the increases in wages. That's a fact. Wage cuts means also less consumption. And now the question is, how much will the Fed be able to increase interest rates before it really starts to having a negative impact on the economy? There is not a big difference between 0% and 2% inflation and 2% interest rates and 7% inflation. This is still extremely stimulative for the economy. So yes, the economy is strong, and if interest rates stay this low and 2% is low, it's likely that the economy will remain strong because this is still highly stimulative. And this is now the key question here. Of course, the economy is strong while emphasizing the need for price stability. And the question here is, what if the Fed doesn't have the power to stabilize prices? What if they have to increase to 5%? Then we would have stagflation. So high inflationary pressures and a recession in the economy. And that's something very, very ugly and very difficult to get out of. And despite the confidence that Powell has, that is a risk from a monetary perspective. But later we'll discuss investing, and you'll see how, despite that, there are more important factors to consider when it comes to investing. And this is a nice comment that I found from Deutsche. The history of being able to guide inflation down from 40-year highs with maximum employment suggests a smooth landing is very, very difficult to achieve, said Matthew Luzzetti at Deutsche Bank. At some point, they will face the trade-off between pushing unemployment higher or accepting higher inflation, and that is a fact. At some point, the Fed will have to say, okay, am I going to 4%, 6% interest rates to curb inflation, what Volcker did back in the 80s and save the economy long term, but now the debt is much higher, so everything is different than back then. And this brings us to Ray Dalio and his long-term debt cycles, where at the end there is an end to the party of zero interest rates and printing money at will, which then again leads to other fundamentals that we have to focus on. And then again, here are the fundamentals. The expectations are that the current situation, partying, borrowing as much as you want, so 4 or 5% budget deficits forever, borrowing like you never need to return that money, and like interest rates will be low forever, that is something that might change in the next 5 to 10 years, and then again significantly impact investing. And the fact is that nobody knows what will interest rates look like in 2023. There can be expectations, but nobody knows. Powell can say what he wants to say, what he wishes that will happen, but the fact is that nobody knows, and that's what we have to focus as investors. It's easier to say, I don't know, I want to do good whatever happens, and then already 95% of the noise out there is eliminated. And yes, the economy will get hit with higher interest rates, there will be less spending, and 68% of the economy is consumption. If interest rates go up, the government will also be forced to lower spending, less budget deficits, etc. So that might hit GDP, and then we might see a recession, which is again normal when it comes to investing. If we check the chart for recessions, the gray line here, you can see that recessions have been there, much more common in the 50s, 60s, 70s, then less and less, but bigger and uglier recessions. And then again, the forecast is for balance sheets to be trimmed, but we have to see whether this will be possible or not, as there is a myriad of factors impacting this. And the key here to understand is that the environment is still extremely stimulative. The real treasury yield is negative 4% now. Negative. This means that if you lend money to the US government, like your pension fund does, you are losing 4% of your capital. 4% of your capital per year, your pension fund has likely 40% in bonds, thus you are losing 2% of your purchasing power when you retire due to inflation and interest rates at the moment, financially engineered interest rates. And if they increase interest rates by 2 percentage points, 200 basis points, it's still negative, you still lose money. And that's something that is very important from a value-creating investing perspective. We as investors have to be above the inflation rate so that whatever happens, we are doing okay. And this is also important. The ECB will keep pumping money into the system, and the Fed will, let's say, stop and then even take out money from the system 2023 and forward, but we'll see how will this be possible or not. That's also a key ingredient there. And if the Fed tightens, we'll see for how long will that be possible, because the government is still borrowing, companies are highly indebted, households, real estate, whatever, the economy is based on debt, so there will be limits, and we will see when the Fed will lose control, and then the situation will be ugly. Now it's not ugly, and that's why the market is still high. And I reiterate myself here, nobody knows what will the world look like in 2 years. If you just go back 2 years and 1 month from now, the world now is completely different than it was 2 years and 1 month earlier. And therefore, I like the quote from Jim Rogers, how every 15 years the world looks much different than it was. We had the early 2000s, then came the financial crisis, money printing, higher interest rates in the early 1990s. Before that we had high inflation, so we don't know what the next decade brings ahead, but it will sure be different from the previous 15 years. And I have really enjoyed the video from Ray Dalio recently published on YouTube about the changing world order. It's a must-see video, so I'll put the link in the description below, and really after watching this video, go and check that video out, because the world is changing significantly, and at some point all these forces that drive the market, that you hear itsy bitsy things on the news, at some point things will change. And the important thing again as an investor is to focus on investments where no matter what you will do well. And you will see that given what's going on, at some point the Fed will lose control. Then we have currency issues, we have this, we have that, we have higher inflation, maybe we'll have high inflation for 10-15 years. Life will still go on, but it will be different. And then on China, I'm really amazed. There was so much news over the last 8 months, a year, that really destroyed Chinese companies, especially stocks traded on American exchanges. But the news is one thing, crazy news, full of panic, full of this. But if you read what the Chinese government has been saying, and now they said, okay, these news people are really stupid, we have to put everything like we are talking to kids in elementary school. Now they said this in the plan. And then of course there were crackdowns, but those were really shady places and environments. And now they said, okay, this is what we will do. But if you listened not to the news, but to what they had been saying, you would have known that it is stable, it is a stable system, and it's projected for economic growth, stability, and the improvement of quality of life, not panic mumbo jumbo. And now, what can we do as investors? What do we have to focus on? My message is we have to focus on investing in businesses. There will be recessions in the future. I can guarantee you that with 100%. The environments will change and everything will happen, and a lot that we don't know will happen. That's a given. So focusing on this short-term news doesn't really matter. If you focus on investing in businesses, that is what is important. Let me show you an example. If we check Apple's stock price, so let's go here, 2012, then we had issues in Greece, Europe, and etc. Then it went up. Then we had issues in China and the world economy going down, trade wars in China, whatever. But if you look at the stock price, it is up 8-fold over the last 10 years, despite constant issues. And let's say that the price-earnings ratio would be still at 10, then the stock price would still be up 3-fold. So 8-fold if it's really good. And now if you invest in businesses, then the key is that you understand that nobody knows whether your long-term returns will be 10 or 15% or 20 or 4. But if your worst case scenario is 4% over a decade, and then the next decade you do 12%, you are still well off. And that's the secret to investing. Nobody can predict recessions, nobody can predict markets, but what you can focus is businesses. Of course, you can check my Apple stock analysis and all the S&P stocks in the link in the description below. And the key for us is to invest in businesses that will grow and that will be stronger no matter what happens with the economy, with the monetary policy, with inflation. And what we have to focus on here is, okay, what is the risk there? If you buy something with a price-earnings ratio of 30 and then we have higher interest rates, it's much riskier because, yes, then it can get slashed by 50% if the market suddenly expects higher returns, and then you have a problem. But if you buy something at a P ratio of 15, then the risk-reward is already much better, because even if the market expects higher returns, still, getting down and down will give you higher dividends, etc. In that line, I will discuss 3 stocks that are better than inflation buys now, and that is Starbucks, 3M, and Verizon. And I'll make a special video for the stocks tomorrow, but really point out the business perspective versus the noise market commentary perspectives. Subscribe for that video, click that notification bell, and I'll see you tomorrow for the stock analysis. Let's continue. And now I want to finish with the outlook on the economy, on how we are living and what will our lives be like 10-20 years down the road. I am extremely positive on that side, because what's the alternative to not being positive? First, when it comes to stock market, you always have to invest the money you don't need in stocks. That's something that is the key rule, and that is the key rule that makes everything easier. First, you have your house, your home, then you have your skills, your job, your education, then you have a safety net so that whatever happens, you're ready. And then, for the cherry on the cake, then you have the stock market and stock market investment. If you don't have it in this structure, then you are on shaky grounds. And then you worry about interest rates, economy, news, etc. And given the clicks the news gets, a lot of you, I assume, are on shaky grounds. And if things go south with the economy, okay, then we might lose some of that cherry on the cake, but still, that is life. We'll have bad decades, we'll have good decades, we'll have 20 years of scrambling by, but if you invest, if you build wealth, and if you understand that wealth is built through ownership and businesses, then you will do well over time. And that's also what we focus here on this channel, to do good no matter what. Check also another investment idea that I shared on my research platform, and also check what I do on my research platform in this video about Intel. Thank you, and I'll see you tomorrow with 3 new stocks.